G'day guys, Alex here from TWP Club. Just wanted to share a bit of information about the Melbourne property market with you today. So if you'll just humor me for 2 seconds, we do a little bit of work around property outlooks and reports, and we also do personalized strategy and structure reports for clients as well, which are all just based off of pure numbers and just presented in a way that we find is a little bit easier for people to understand for their investment goals. So jumping right into it, when we're looking at the Melbourne property market, we have to look at that here as a, I guess, relationship with the population growth. Where the demand is, obviously, that is where we're going to see the most amount of value growth. So if we are not building enough property in areas where we need a lot of property, that obviously is a huge driver for us. Now, that doesn't work for you when people are leaving your state for other states. And I see that as a big problem for the Sydney property market, but that's for another conversation. So looking at the Melbourne market itself, really the biggest thing to understand is the size of Greater Melbourne compared to Greater Sydney. Both very, very close at the moment, 5.6 versus 5.4 million there. The big kicker here, though, is that there's a 30,000 annual growth disparity between Melbourne and Sydney there. You're looking at a 2% annual growth rate for Melbourne and 1.4% for basically Sydney there. One of the big issues that Sydney has is a very large loss for net interstate migration, which is people moving from Sydney to Melbourne or Melbourne to Brisbane, whatever it might be. It's the inflow versus the outflow. Now, Sydney may be the first decision or sort of location for people when they come to the country, but then they very quickly realize it's very expensive and they move either to Melbourne, Brisbane, Perth, somewhere else. And what we're seeing there is now there's more and more people from the overseas migration moving directly to Melbourne. So there's a huge demand there for property. And it does look like by the early 2030s that Melbourne will be the largest capital city in the country. We've got a big difference in terms of the rentals achieved in Sydney versus Melbourne. Obviously, people will say that's Sydney. Yep, absolutely. But there's a 22% difference in rental for pretty much the same experience, same income, same jobs, probably better coffee, let's be honest. But, that's a big difference there. Then when we pair that with the price point for Sydney versus Melbourne, certainly more affordable. And what we're looking at there is a 28% difference in the pricing there as well. So that's a big indicator for us to say where the Melbourne property market sits on the property cycle. And I would say, with almost certainty, we are now at the bottom of the market. We may be very near the bottom of the market. The market may not have turned yet. Maybe it has turned a little bit. We just don't know where it is, but it's certainly down here. Rental yields will improve. They'll keep on pushing up as the demand for housing, particularly in rental markets in those key locations, goes through the roof. And then what we see is as the yields start to increase, the value of the property through the sort of cap rate valuation approach then pushes up as well. Where we see sort of Sydney is certainly that peak of the market there. It may not even go into this decline for a while, but it's certainly not going to be pushing rental that much higher than where it is at the moment. People are moving interstate, and they have been shifting for some time, but there is no property surplus in any area in the country at the moment. So it's a very delicate sort of market, but there's certainly opportunity when you're buying at a premium discount to all the other major capital cities. So the entry price is certainly a big factor for us. One of the other things that I quite like about the Melbourne property market is little things like the co-living or the rooming house class 1B sort of benefits there. What you've got is a potential for a land tax exemption through that property, and I'll walk you through that process on the next slide. But those co-living properties have got tremendous amounts of depreciation. They've got a very good, strong rental income. You're saving money on tax. And when you look at these as purely an investment, as an asset over the long term, like long term, long hold, they work out very, very, very good. And I believe that you'll see a lot more of these needing to be built as the take up of tenants is not meeting sort of the projections and what's required. People cannot afford to live in their own home. If there's no homes available, there's just no homes available. You have to live in an apartment, or you have to live somewhere else. So this is sort of solving a critical need in the market as well. So when you register your property as a rooming home, and you're confirming that it's being used primarily as a rooming house, confirming obviously that you don't live in the property, none of your relatives live in the property. You made that declaration of exemption to the State Revenue Office, and then a land tax exemption may apply to your situation. But ticking the boxes, following the process, there's really very little that can go wrong in that process, and clients have done that by themselves. We can certainly assist in that process as well. So it's very, very straightforward. This is what a co-living standard sort of typical house would look like. This has got 5 bedrooms, one, two, three, four, and then five down here. Each of them have all got their own ensuite bathroom. There is a sort of very large laundry space here, and we've got communal area here. Everyone's got their own pantry here. All the doors lockable. All of the class restrictions, fire escape, smoke detectors, everything that you need in a property of 1B is included in this package. So this is completely kitted out exactly as the property would be rented out on the market. When you look at the actual figures for this though, that's where it really starts to shine. So got a purchase price of 760, $16,000 worth of expenses, setting up the property. That's stamp duty, legal fees. There's also 25,000 not showing in here, which is the furniture package, takes the total loan to 803. Now, assuming 100% borrowing using equity from another property, just to really highlight very conservative figures, 100% borrowed. We're going to just go with pretty standard sort of figures here. Okay. Capital growth, 5%. So we're not being overly aggressive or something crazy. Inflation, we're projecting 3% forever, basically. The gross rental, $1,100 per week. So over here, I'm going to jump straight into year one, 56,000 annual income. We've got the interest expenses and the rental expenses. Those rental expenses, these are the cash deductions. This is actual expenses out of your own pocket. That's your agent's commission fees, letting fees, council rates, water rates, insurances, maintenance, mowing, internet. Everything is all included in this. There's no sort of hidden figures, and you can see how it still works out with all of those expenses. So from a pre-tax cash flow point of view, it is $6,500 negative here. We then allow for our non-cash deductions, building depreciation, fixtures and fittings. And because we've got 5 bedrooms, we've got 5 furniture packs, we've got 5 en suites, we have 5 of everything that's expensive. We can claim quite a bit of that back in depreciation. Now what we've got here is total deductions of 81,000. Okay, so we've got total income 56,000 and total allowable deductions of $81,000. We are claiming a fairly significant loss. Now, break down those figures as well. We're assuming here a 50-50 partnership, 150 and 75. They're both getting the exact same amount of rental split down the middle, increases both of their incomes. We then allow for the rental deductions, which are again split evenly between them, and that reduces their new taxable income. So they were previously paying 39 or 14. Okay, so from 39 they're going to 34, and from 14 they're going to 10. So the actual tax saving is 4941. So you get $4,921 tax refund and 4,102 there. Total 9,024 total refund there. The cash that they lost was 6.4. It's covered by their tax refund, leaves them with 2.5 grand or $49 per week income from this property. So let me break this down for you. There's 100% borrowing. We're not being overly crazy with these capital growth projections at 5%, but by year 10, the property's worth, what, 1.2 million, and you got $435,000 worth of equity in that property from 100% loan. So that effectively divide that by 10 years, $43,500 per annum of accrued value over that 10-year period. And it's cost you nothing because it's putting money back into your pocket every single week. So 100% borrowed using purely your tax dollars there to fund the cash shortfall from this property, because there is still going to be a cash shortfall if you're borrowing all the money and you're paying 6.2% interest rate there, then you are going to be paying some money out of your pocket towards that property. But it is, after all is said and done, putting $50 a week into your pocket. You're getting paid $50 a week to hold onto this property, and we'll come back to you in 10 years' time. And then you can sell it then and make 435,000 profit on that property. If you want to sell it, then pay your CGT, whatever. It's still 20 grand per annum that you've put away in cash for 10 years' time on a very conservative 5% capital growth rate, which we expect to obviously see do better than that. But the thing pays for itself so well. Depreciation's there, tax benefits are there. It's a great property and it's got a great story behind it, because you are actually helping people to rent in decent accommodation in a decent location. And it's really, yeah, it should be financially rewarding for those that are investing into that space as well. So just bear that in mind. The process, if you are interested in buying a property like this, you go through an expression of interest sort of process, fill out a form. We confirm the property is held for you. We set up your file, getting your ID and everything that we need. If there's a holding deposit that gets paid, contracts are then issued. Your solicitor will review those. Once you're happy with them, you'd sign an exchange, and that would be subject to any finance or due diligence clause if needed. And then it moves to unconditional. Now, throughout that entire process, we manage and follow up everything for you, including any escalations or any issues you might have. If you need assistance with nominating a solicitor or a broker to review the file for you, we can certainly help in that regard as well. So if you liked that today and you'd like to connect with us, you can join us, subscribe on our YouTube channel. We've got TikTok, we've got our LinkedIn as well, Facebook and Instagram. So hopefully that was good. And yeah, if you have any questions, we'd love to hear from you. Cheers.